All right, today we're going to dig into a topic that isn't just some side note to trading. It's the absolute foundation, the bedrock of any long-term success. We're talking about risk management.
So let me just start by asking you this. What do you think is the real key to making it as a trader in the long run? Is it some secret indicator, a perfect entry strategy? Well, the answer might not be what you think.
Because the truth is, none of that stuff matters without this one core idea. You see, trading without risk management, it's like trying to drive a Formula One car with absolutely no brakes. Yeah, it's going to be a thrilling ride, right up until that inevitable, catastrophic crash.
And that's exactly why this is so critical. Risk management is really the unsung hero of profitability. It's often way more important than finding the perfect strategy. Let's break down exactly why that is. First and foremost, it's about capital preservation. Look, your number one job as a trader isn't to make a fortune on every trade. It's to not lose the money you already have. Because without capital, you're literally out of the game. Risk management is what keeps you at the table.
And second, it builds consistency. Even the world's best trading strategies have losing streaks. That's just part of the deal. But with proper risk control, those inevitable losing streaks don't wipe you out. It smooths out the equity curve and actually gives your strategy's edge the time it needs to play out over the long haul.
And this leads to what is arguably the biggest benefit of all: psychological stability. When you know for a fact that your maximum loss on any single trade is controlled and totally acceptable to you, it frees you from that emotional roller coaster of fear and greed. And those are the emotions that lead to terrible, impulsive decisions. It lets you trade with a clear head.
The legendary trader Ed Seykota, he said it best. The elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. He's not just repeating himself for effect. He's being deadly serious. This is the entire game. If you can master this one thing, you actually have a fighting chance.
So that's the why, but how do we actually do it? Let's open up the risk management toolkit and take a look at the core principles and techniques that every successful trader absolutely lives by.
We're going to focus on these 4 pillars: how much you're actually putting on the line per trade, where you get out when you're wrong, how you weigh your potential profits against your losses, and how you protect your overall account from a big hit.
Let's start with what is, without a doubt, the most critical one of all: position sizing. Now, this isn't about how many shares you buy. It's about how much money you stand to lose. This single decision has more impact on your survival as a trader than almost anything else.
Here's a really simple way to see how it works. Let's say you've got a $10,000 account, and you decide you're only going to risk 1% on any single trade. Okay, that's $100. If your analysis tells you that your stop loss needs to be $2 below your entry price, well, the math is easy. You just divide your $100 max risk by that $2 per share risk. And what do you get? 50. That tells you exactly how many shares to buy. Your position size is now driven by risk, not by a random guess.
And that $2 per share risk, that's defined by your stop loss order. Think of this as your eject button. It's the price you decide on before you even get into the trade, where you say, okay, I was wrong, and you get out to protect your capital. This has to be an absolute non-negotiable rule, every single trade.
So, why do we go through all this trouble? Well, it's so we can find trades that have this kind of asymmetry. We want our potential reward to be a lot bigger than our risk. A great rule of thumb is to only look for trades where your potential gain is at least 2 or 3 times bigger than your potential loss.
And here's why that asymmetry is pure magic. If your winning trades are, say, 3 times bigger than your losing trades, you don't even need to be right half the time to be profitable. I mean, think about that for a second. You can be wrong more often than you are right and still make money consistently. That is the power of professional risk management.
Which brings us right to the mental side of the game. Because having this kind of framework, it gives you a massive psychological edge. It completely transforms your mindset from one of constant anxiety to one of cool, calm objectivity.
Without rules, trading is a mess of fear, greed, and impulse. But when you have a solid risk plan, you start to operate from a place of discipline. You become calm, objective, and confident in your process, no matter what happens on any one trade.
And that's the crucial shift in your thinking. You stop trying to fight the market and you start simply managing probabilities. By defining your risk before you ever click buy, you take the emotional burden completely off the table, and that allows you to execute your plan almost flawlessly.
Okay, so theory is great, but how do we make this stuff real? Let's walk through the exact steps you can take right now to put disciplined risk management into practice.
It really boils down to a 4-step process. First, develop a trading plan. Actually write it down. Your rules for entry, exit, position sizing, make it a real document. Second, use automated orders. The second you enter a trade, put your stop-loss order in. Take your emotions completely out of it. Third, you got to keep a detailed trade journal. Track everything so you can see what's working and, more importantly, what's not. And fourth, regularly review and adapt. Markets are always changing, so your plan might need to evolve too.
At the end of the day, it all comes down to this one simple idea. A trader with a great strategy but zero risk management, they're just a gambler with a system. But a trader with even a decent strategy and excellent risk management, that's a professional. That is the fundamental dividing line. So I'll just leave you with this one question to think about. Go back and look at your last 10 trades. Was the outcome a result of a disciplined process for managing risk, or were you just getting lucky? Your honest answer to that question is going to define your entire future in the markets. Thanks for tuning in.